Hey, what's up my friends? So in this week's market analysis, alright, we'll be looking mainly at the commodity currencies because from what I noticed, alright, the commodities and the commodity currencies right now, they seem to be one of the more volatile products to trade. So we'll be looking at it, namely the Aussie dollar, the New Zealand dollar, dollar Canadian, as well as gold. Because from the looks of the chart right now, gold I think is been quite a volatile morning, right, on this Monday's morning. So we'll also have a look at gold. And pardon this a metallic thing down here because what it does is actually to filter out the pop sound that comes out from my mouth. So this kind of like filters out the very loud pop 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 kind of thing that you've been hearing over the last few months. So this thing here should do the trick. And yep, all this and more in this week's market analysis. I'll see you there. Okay, so this is the chart of Aussie dollar. So you know Aussie dollar, I mentioned last week that I was bearish on it. So let's do a recap on why I was bearish. So you look at the weekly chart on the Aussie dollar, it's very clear that the trend is down because I think I get quite a number of questions from traders asking me, hey Rainer, how do you know when the trend is up or how do you know when the trend is down? And the answer I always give them is, I look my chart from left over here to right over here. So if I see the price from left to right is going lower, then it's telling me that the trend is down. And likewise, if from the chart I look from left to right, price is heading higher, the trend is up. It's as simple as that. But of course, there are different types of trend, whether the trend is a very strong trend, it's a weak trend. Those are, I would say, require further classification. But as a basic rule of thumb, right, I basically look my charts from the left to right and I would know immediately whether the trend is up or down. If you don't believe me, you can try it, stand further away from the monitor, or what you can do is, to zoom out a little to have a bigger macro perspective or bigger picture of what the trend is doing, what is the longer term trend doing, the medium term and the short term trend. So this is something to help you along the way, and hopefully it helps. So if you have anything that you still want to ask me regarding how to identify a trend, feel free to leave in the comment section and I'll do my best to help you. So looking at the daily chart, last week I mentioned that we have this head and shoulders pattern over here, followed by this neckline. So traditionally, right, in most classical technical analysis textbook, they say that the head and shoulders pattern is a reversal pattern. But for me, I use the head and shoulders pattern as a continuation pattern because previously what we have is a trend towards the downside. And right now we have this head and shoulders pattern, and it's a sign of it telling me that the bears are still in control. Why is that? Let's understand it from a price action context. So basically you have this impulse move lower, then price traded higher, then it took another step lower, but it couldn't take out the previous lows over here. So what happened is that it then traded higher once more, right? A steeper than usual retracement, then price swing all the way back down, right? Signifying that the bears are in control once more. Now, the bulls are trying to take control once again. So they try to stage another rally, but then it only stopped over here, right? The rally ended down here. The bulls couldn't take price any higher, and then the bears came back in control, pushing price down lower. So what you see is that what you see basically on this chart, right, ignoring the head and shoulders, is that a rally towards the upside, then the bears came back in control. The bulls staged an even stronger rally, and the bears came back in control once again. The bulls did another rally once again, but the bears finally took control once more and pushed price lower. So, well, you can use head and shoulders pattern and memorize the meaning behind it, but for me personally, I don't do that. I would rather understand price structure itself, because once you can understand price structure, you don't have to go about memorizing all these patterns in the market, because once you can read price, all this becomes pretty much secondary. So if that is confusing, don't worry, along the way, as I do more weekly market analysis, as I, conduct more regular training webinars, I'll go and explain all these technical details in more details in the days ahead. So this is my take on the Aussie dollar. And last week I mentioned that I went short when price formed this flag pattern, basically I got short already, and not sure whether price will go further in my favor or will stop me out and rally higher. So this is something that is not within my control. The only thing that I can control is where I'm looking to enter and how much I'm willing to risk, and when to get out when I'm wrong. These are the factors that I can control. What I cannot control is whether the market goes in my favor or goes against me. This is entirely not within my power. So that's all for the Aussie dollar. So looking at the New Zealand dollar. So looking at the weekly chart, the New Zealand dollar, like the Aussie dollar, it is also bearish, right? We have lower highs and lower lows, right? You see a lower high here, lower high, a lower low, and lower low. So I would say over the last few weeks, namely this portion over here, if you calculate over the last 14 weeks, 11 weeks, it traded lower, and 3 weeks, it traded higher. So just by looking at this simple statistics over the last 3 months, right? Because 14 weeks is about 3 months, you know that the path of least resistance is towards the downside. So I would say, for me, I'm only looking to short the New Zealand dollar as well. I'm not looking to stay long because I'm not a counter trend trader. I'm a trend trader. I'm a trend follower. So wherever the trend is, I would just look to trade it. All right. I don't believe that, because for me personally, I believe that what is low can go lower. So I don't try and predict, price is so low, it cannot go any lower. I don't think along the lines. Instead, when I see price so low, I tell myself that it can go lower. So I'm going to trade it towards the downside. So looking at the forward charts, some trading opportunities that I've identified is the 20 and 50 period moving average. It has acted as dynamic resistance over the last few weeks. So again, if price does retrace back towards this zone, for me personally, it's a shorting opportunity. Right, it's an opportunity to scale in my shorts. So we'll see what happens next in the coming days. So up next, let's look at dollar Canadian. So dollar Canadian, again, another commodity currencies. All right, previously we've covered the Aussie, the New Zealand. So this is the dollar Canadian, another commodity currency. And looking at the weekly chart, again, it's bullish, right? You see that the 20 and 50 period moving average over here has been acting as dynamic support. And obviously, you're not trading off the weekly chart. So, if you want to trade off the weekly chart, I can say that, that there isn't many trading opportunities, because trading, according to my approach, you would have to wait for price to come back into this zone over here to get long. And that may take months, or it may never even come, because, price could just rally higher and never look back. So for me, I don't trade off the weekly chart, but rather I take my bias off the weekly chart. So how I'll get my trading set up is I go down into the lower time frame. So looking at the forward chart over here, now this is clearly something different, because we can identify tradable patterns on this chart. So where is it? Is that if you notice, the 20 period EMA has been acting as a dynamic support. So any retracement back into this zone over here is a long opportunity for you. Or if you believe in trend following, you believe in my methods of trading, then yes, it could be a trading opportunity. But bear in mind, right, because the Aussie dollar, the New Zealand dollar, and the dollar Canadian, right, these three products, they are all basically dollar denominated. So what does that mean? Is that you are basically amplifying your risk on the dollar. Basically, you're betting on the bullishness of the dollar. And my advice to you is that if you want to trade all these three different currencies, is to split your risk accordingly. Because you don't want to be, for example, you risk a typical 1% on each trade. You don't want to put 1% on Aussie dollar, another percent on the New Zealand dollar, another 1% on the dollar Canadian. Because what you're doing is just basically betting on the bullishness of the dollar. Instead, what you could do is to reduce your risk. So perhaps, instead of risking your typical 1%, you can reduce it to maybe 0.3%. So on 0.3% and 0.3%, right? So all these three added up, you are still only risking your usual 1% a trade. Well, technically it should be 0.33, but I just rounded it down. So again, this is entirely up to your risk management parameters, right? If perhaps you don't want to risk 0.3, you can risk 0.5, right? This is entirely up to you. But the message that I'm bringing across is that you are basically, amplifying your risk on the dollar because of the 3 different currency products which are dollar denominated. So be aware of amplifying your risk. So what I could suggest is to reduce your risk accordingly. So this much I have to say. And last but not least, all right, let's have a look at gold. So gold, this is the weekly chart. I'm not sure if last week I covered gold, right, saying that I was actually bearish on it, right? There's a potential breakout. So let me just do a recap, whether I did cover it or not, right? So just bear with me for a while. So looking at the weekly chart, you see that you have lower highs over here, over here, over here, over here. And you have this structure support which comes in around the multi-year lows. So what it's telling you is that the bears are in control because, this was a lower high. Then the bulls tried to stage another control, but the bears came in and pushed price down lower. The bulls tried to gain control, but the bears came in once again. So each time the bulls try and push price higher, you notice that the rally is getting weaker and weaker, right? See, the first rally by the bulls was pretty strong. This was a strong rally. Then this rally got weaker, and finally got even weaker over here. So it's telling you that the bulls are being subdued by the bears, right? Based on the structure of the charts, you see lower highs. This is why you see lower highs on the chart. And this was the multi-year support. And no surprise that those who are longs would probably put their stop loss just below this swing low over here. So when you have enough traders putting their stop loss at this location, what happens is that when price trigger the cascade of stop loss, it will trigger a stop cascade whereby the stop loss trigger a massive wave of selling. And if there is insufficient liquidity below, right, if there is not enough buyers below, right, this region over here, what happens is that you see a large sell down like this. So looking at the hourly chart will be clearer. Now you can see the impact of the selling. So basically, right, this candle over here was a very huge sell down. It's only a Monday morning, so I have no idea what would happen next. So it'll be interesting to watch, right, whether gold will hold the sell down, whether the breakout will continue, or price could perhaps rally all the way back up and close higher, because the markets is just that dynamic. You can't predict what it's going to do. So this is why you always have your stop loss in place, because trading without stop loss is financial suicide, right? It's trading is a trading sin. Because let's imagine this for a while. Say for example, this is the hourly chart, 1 hour. So you say for example, you notice there's a swing support down here, and you thought price cannot go down any lower. Gold has been selling off for week after week, and there's a good chance that it has bottomed out. So what you do was you got long when you saw this green candle over here, and you did not use a stop loss because you don't believe in using stop loss, because price always comes back in your favor. So there's no need to worry about having a stop loss. So you went long on Friday. So Monday you come in and you notice this huge wave of selling over here. I can tell you that if you are trading without a stop loss, there's a good chance that you'll wipe out your entire trading account. Alright, this candle is not something that happens very frequently. But when it does happen, it takes out a lot of players out of the game. So trading without stop loss is like this. You win perhaps 99% of the time, right? 99% of the time, you make money because, price eventually goes in your favor. But all you need, right? All you really need is just the 1% of the time, which is this candle over here, this red color bearish candle over here, to take you out of the game entirely. You're wiped out. Totally. So this is why I always emphasize having a stop loss in place, because there's no way you can predict what the markets can do. So your stop loss is like an insurance, right? To protect you in case of something really bad that's going to happen. So that's all I have to say for this week's market analysis, alright? Sorry for being a little draggy, right? Sorry for, if I sounded like I'm reprimanding you, because trust me, that's not my intention. I just want to educate you on the importance of having a stop loss in your trading. So that's all I have. So if you have any questions, right, feel free to leave me a comments below. With that, I wish you good luck and good trading. I'll talk to you soon.